Well, welcome everybody. I'm Jeff Quick, financial advisor with Paladin Financial. I'm here to host your fourth quarter client educational webinar, Navigating the Post-Election Landscape. So let's go ahead and get started. Thanks everybody for taking time out of their day to spend with us. Topics for today, we're going to talk about a few things: election results, market history in election years. We'll touch on the Tax Cuts and Jobs Act, year-end financial opportunities, as well as deadlines here at Paladin Financial and Gradient Investments. So we'll go ahead and get started here. Well, let's talk about the election results a little bit. If you're like me, regardless of whether your candidate won or not, I think we're all glad that it's over. It's not being contested. A smooth transfer of power seems to be in the cards, and we can all start to move forward. These are all good things. The presidential election, okay, we have a new president-elect with Donald Trump winning both the Electoral College as well as the popular vote. The last time a Republican candidate won both the electoral and popular vote was 2004, when George Bush beat John Kerry. When Trump won in 2016 via the Electoral College, he actually lost the popular vote, which caused some controversy, even those challenging whether or not we should keep the Electoral College in effect. The United States Senate, these races are all but complete, with Republicans taking control with a 53-47 margin in the United States Senate. As far as the United States House of Representatives go, last I checked, there were still 12 waiting to be called, but it is expected that the Republican Party will have a small majority in the United States House of Representatives as well, controlling the Congress moving forward. This is a trifecta. Again, the last time Republicans held a trifecta in Washington came in 2017 and 18 during Trump's first term, when he signed into law dozens of bills, including a $1.5 trillion tax cut. You'll notice most major legislation takes place when one party controls all three. Democrats held a trifecta in 21 and 22 under President Joe Biden, which helped lead the passage of the Inflation Reduction Act. Holding all the levers of power in 2009 and 10, President Barack Obama pushed across the finish line the American Recovery and Reinvestment Act, a major overhaul of the U.S. financial sector, and the Affordable Care Act. Republicans have regained control of the Senate, which is responsible for confirming the president's cabinet and judicial nominees, including filling any Supreme Court vacancy. This happens now with a simple majority. One thing I'd just like to point out, as these elections take place, we need to concentrate on the things we can control, right? There's certain things we can control, such as time in the market. Notice that's not timing the market, which is impossible to do, but time in the market. The sooner you get your money invested in the market, the longer it's there, the more predictable your returns become. Asset allocation is key. You want to make sure your asset allocation matches your personal risk tolerance according to your plan. You can also control the diversification of your investments. So when we say diversification, we're talking about growth stocks, value stocks, small, mid caps, international. You want to make sure you're well diversified, which will help smooth out the ride throughout your retirement. Rebalancing is also something you should be doing on an annual basis, along with your financial advisor. If you think about what rebalancing actually does, it forces you to sell high and buy low. For example, if one of your investments is up 40%, another one is flat or down, you're going to take money from that higher earning investment and reallocate that to something that has gone down or has not increased as much, helping you to buy lower and sell high, which is going to help you receive a better return overall. You can control how much you save and how much you spend, right? You can always save more. The more you save, the better off you're going to be. Monitor your spending. Make sure in years when maybe the market is not performing as expected or as you would like it to, you're keeping an eye on spending and maintaining control over that as well. The last thing you can control is your emotional responses. And really, if you've taken the time work with your advisor to do the other things, asset allocation, diversification, tax planning. All of these things, when complete, will really help you to manage your emotions and not make rash decisions. Now, of course, on the other hand, there's a lot of things beyond our control, right? We just went through the elections. Yes, you have a say in that, but you can't really control the outcome. Nobody controls what the market does, right? We would like it to go up each and every year, although that's not possible. Tax laws may be changed, interest rates go up and down. You can't control what other people do, right? We have a lot of conflicts taking place around the world right now, also out of our control, along with inflation. So let's look at what happens when an election year is here. So this year, after Donald Trump was elected president, the stock market rallied to record highs following the news. On Wednesday, the day after the election, the Dow Jones logged its best day in 2 years, up 3.6%. The S&P and NASDAQ both reached record highs as well. Good news for stock investors is the final quarter of a presidential election cycle has one of the highest proportions of positive returns. Over 83% of the returns in that last quarter of an election year are positive. Now, the returns aren't necessarily large, they average 2.5%, but the chances of having a positive return during that last quarter are extremely high. Markets generally react positively to the degree of uncertainty that's been removed from the presidential race, right? There's a lot of uncertainty heading in. We notice here clients are nervous, not wanting to make decisions. Once that takes place and we know what the future holds, the market tends to recover and pick up speed just based on the reaction and the removal of that uncertainty. In each of the past 5 presidential elections, the S&P 500 index has risen in the first year following the November vote. There have been some big gains and small ones. In Bush's second term, the S&P 500 gained 7.4% compared to the 38% gain we saw after Biden was voted into office. Again, concentrate on the things you can do, diversify your portfolio, make sure you're properly allocated. Dollar cost averaging is also great if you're currently contributing to an IRA, retirement plan, maybe an employer-based plan. If you're investing on a regular basis, even when the market goes backwards, now we're just buying it at a lower cost. So dollar cost averaging is a great thing to do. Consistent investing will help your overall return. At Paladin Financial, we use the bucket approach a lot as well. So your short, medium, and long-term investments should be invested differently. If we have money in that short-term bucket, meaning we're going to use it in the next 1 to 5 years, we want to make sure it's invested somewhere conservative. So that's your green money, right? We know it's going to be there when we need it. As we get further and further out, the need for income or the need to access our investments, we can afford to take more and more risk, knowing that time is on our side. And history says when invested for long terms in the market, right, the S&P 500 returns on average about 10%. You can meet with your financial advisor if you have any concerns or questions regarding any of this. It's always a good idea to give your advisor a call when you have questions or concerns regarding your investments or the markets in general. Tariffs. Tariffs have been a big talk. So let's touch on tariffs a little bit. So what are they and how do they work? A tariff in its most simple form is just a tax imposed by one country on goods and services imported from another country. Now, historically, they've helped governments protect domestic industries from foreign competition while also increasing revenues. Today, tariffs are also the most basic tool countries use in a trade war. If the countries involved are large enough, they may use tariffs as a way to exert significant pressure on another in order to extract concessions on trade or other areas. The general idea is that by making foreign products more expensive, governments can encourage their own citizens to buy from domestic producers instead. Producers that might not be able to compete otherwise may have an opportunity for success. In theory, It's really a way for governments to boost the domestic economy while reducing their overall trade deficit. Now, it's much more complicated. Increasing prices, remember, a tariff is a tax, and they can often lead to a reduction in gross domestic product in the short term as goods and services become more expensive for consumers. In the long run, protected industries may also become less efficient or innovative due to the loss of competition. There's almost nothing more contentious in the world of trade than tariffs. They've been around for as long as people have been trading goods across seas and states. To this day, economists debate the exact effect on economic growth. And I'm sure we'll be hearing a lot about that as we move forward and you hear different viewpoints on tariffs and what the impact is going to be. So under Trump's proposal, the US would impose a tariff of at least 10% on all goods coming into the United States from overseas. And he's proposed a 60% tariff on products being imported from China. Tariffs are actually they're paid to the federal government by the company importing those goods, like a retailer or a manufacturer. Those companies can either pass the costs along to consumers by raising prices or absorb the costs and take a smaller profit. I think we know what they normally choose to do. Now, there may be a combination of both, right, to maintain competition. But in past, if tariffs are any indication, consumers will likely see higher prices. Not only do companies often pass along the increase, as we discussed, but even competitors who are not subject to the tariff often also raise prices, right? Because they can, they may take advantage of the increased prices from competition and jump on board and raise their prices as well. Actually, companies including AutoZone and Black & Decker have already warned investors that they will be raising prices if Trump carries through on his tariff proposal. Tariffs enacted by Trump in 2018 and 19 did lead to higher prices for a range of goods that included washing machines, handbags, and tires, according to the study by the National Bureau of Economic Research. I know that I had purchased a home at that time, and it took me a couple months to get a washing machine on order because everything was back ordered. They weren't available. It was quite a hassle back in 19 and 20 to get something. Now, there is an impact of these tariffs, economic effects of tariffs on goods and services. Again, as we stated, they do increase costs, right? Higher prices for imported goods and services, which affect both consumers and businesses. It can also impact the supply chain, right? Disruptions in the sourcing of materials and services due to those tariff changes can also cause challenges and cause prices to go up. If the supply chain is impacted, there aren't as many things available, the goods and services, the prices are going to increase in order to get those. There can also be shifts in demand. Domestic goods may become more attractive due to the increased price on imports. I think this is what they're hoping happens, right? If you add tariffs, more people will start to purchase domestic goods. Prices may be a little bit higher, but it may be good for the overall economy moving forward. All right, let's touch on the Tax Cuts and Jobs Act a little bit. Now, this became effective 6 years ago as a major Trump administration tax code overhaul, making it the biggest change to tax law and policy in recent decades. That's why they often refer to the Tax Cuts and Jobs Act as the Trump tax cuts. However, many key provisions in the TCJA are set to expire soon, as a matter of fact, at the end of next year, 2025. If Congress doesn't act, tax rates will revert back to pre-levels, which were much higher than they are today. Some call it a tax cliff, sunsetting tax laws. This would take place starting January 1st of 2026 if nothing is done. Now, this will affect millions of taxpayers across the United States since its provisions cover everything from changes to standard deductions, child tax credits, income tax rates, even the availability and amounts of other popular tax credits and deductions will be impacted. In the last days of 2017, they passed the American Jobs Creation Act. It had three key changes. One, marginal tax rates were lowered, right? If we look on the slide on the screen, tax rates were reduced. They're temporary. Now, again, expiring at the end of 2025, unless something happens. The 12% tax rate would go back to 15%, 22 to 25, and of course, the 24% tax bracket would go back to 28%. So these increases can be quite significant. Oops. The other thing that was impacted, right, was not just the tax rates, but the tax deductions were impacted as well. We go back to the screen here so we can see what they were, right, the last days. So the tax rates were increased. We can see the changes in deductions. If we look here, if we just take a couple with taxable income of $100,000, if we look at current laws, right, total taxes on $100,000 of taxable income are currently $12,613 for an effective tax rate of 10.8%. If tax rates revert back, right, total taxes on that same $100,000 of taxable income would be $16,477 for an effective rate of 16.5%, almost a 6% increase in overall taxes. Here's the standard deductions, right? If you look at this, you know, you're going to pick the better option, of course, between standard and itemized deductions. Standard deductions currently, married couple filing jointly, $29,200. If they revert back, they will go to $12,700, cut more than in half based on current standard deductions. So of course, extending the tax cuts also means the country's annual budget deficit will go up, just as the tax cuts did during Trump's first term. Though the president-elect has repeatedly said he would like to reduce the deficit, tax cuts have added between $1 to $2 trillion to the federal debt so far. Higher interest rates mean it's now more costly to service the country's debt, so extending these tax cuts would add at least $3.9 trillion through 2035. That's according to the Committee for Responsible Federal Budget. A couple other things to look at. Again, expectations. There's one part of the original plan that he's proposed repealing. That would be the $10,000 cap on state and local tax, known as the SALT deduction, which lets people deduct their property taxes. Those subject to the cap are primarily affluent homeowners in high tax states like New York and California. The state and local tax deduction allows taxpayers who itemize, again, you have to itemize to take advantage of the SALT deduction. This includes certain taxes paid to state and local governments and includes property taxes and either income or sales tax, not both, either income or sales tax, depending on which one is more beneficial for you. So again, established by the TCJA of 2017, the SALT deduction is currently capped at $10,000 for single filers, heads of household, and married couples filing jointly. To claim the deduction, again, you must itemize your deduction on Schedule A of your Form 1040. If your total itemized deductions do not exceed the standard deduction, it may be more beneficial, again, to take advantage of that standard deduction. State and local taxes, again, you cannot do both. If it is eliminated, it would add about $1.2 trillion to the debt over the next decade and push the total cost of extending these tax cuts to $5 trillion. Again, that's according to the CRFB and the Tax Foundation. Around 92% of the cut would benefit households in the top 10% of earners. All right, let's touch on year-end deadlines a little bit here. So the big things to look out for as we approach year-end are really twofold. One, required minimum distributions. These could take place either on your own IRA qualified account or inherited IRAs, which we'll touch on a little bit, as well as Roth conversions. So a couple of things to be aware of here. Required minimum distributions begin currently at age 73. Those will be pushed back to age 75 starting in 2033 with the passage of the Secure Act 2.0. So in the year you turn 73 years old, this is known as your required beginning date, you'll be forced to take a required minimum distribution. You can push off that required minimum date, distribution date until April 1st of the following year. Now, keep in mind, if you choose to delay your first RMD until April 1st of the following year, that will require you to take 2 distributions that first year. So for most people, that's not going to make sense. You'll want to take your RMD in that first year you turn 73. What that will do is that will spread that income out over a couple of additional years. Now, there are some situations where you may want to push that off until April 1st of the following year. Maybe you're retiring that following year and you're going to be forced to take those distributions from your qualified account to meet your income needs. Then it may make sense to push that back and not take that first distribution in the year where maybe you're still earning a high income. Now, like everything else, consult with your financial advisor and or your tax professional. Now, for Paladin Financial clients, don't worry too much about required beginning dates, RMDs. Your advisor here is on top of it. If you haven't received a call already, you will be in the coming weeks to help you determine how much your RMD will be for 2024 and which account you should take it from. Keep in mind, if you have multiple IRAs, you have a required minimum distribution based on the whole of those assets, but you do not have to take them out of each account individually. You could take all RMDs from one account as long as the total amount is equivalent to your overall qualified assets that you need to take that distribution from. So a couple of other things. For inherited IRAs, things are a little bit different. Now, inherited IRAs, you haven't had to take a distribution for the last handful of years. IRS has again established that for 2024, there will be no excise tax on required distributions from inherited assets. So you do not have to take one this year. Now, this doesn't change the fact that any inherited account, now this is both traditional as well as Roth assets, they must be completely depleted by the end of the 10th year post-death. So you need to make sure those accounts are completely liquidated by the end of the 10th year. Now, there's 2 different situations here. If you inherited an IRA from somebody that was from the deceased and they were of required beginning date, meaning they had already started taking RMDs from the account, you are required to take annual distributions from that based on your age. Okay, so if they were taking out RMDs, number one, you need to make sure they meet the RMD for the year they pass if they had not already taken it. So you'd be required to take that one, and then each year following, you need to take a distribution from that inherited IRA based on your life expectancy. Now, this does mean in that 10th year, there's a good chance there's going to be a balance left in that account. It's probably going to grow. Depending on your age, your distributions may be quite small. So you could put yourself in a position where you need to take a large distribution in a single year. So again, this is something you're going to want to monitor and make sure you don't get stuck being forced to take a distribution larger than you anticipate that could potentially bump you up into a higher tax bracket. Now, again, if those inherited assets, the individual had not started taking distributions yet, they had not reached the required beginning date, meaning they passed prior to having to take distributions, you do not have to take distributions from that inherited asset until the end of that 10th year. So a couple of different situations there. So if you didn't understand exactly everything I went through, rest assured your financial advisor here at Paladin is keeping an eye on it, and we'll make sure you do not miss any required minimum distributions. We talked a little bit about this, so a couple things. Inherited IRA, traditional Roth, both must be depleted by the end of that 10th year prior to 2020. If somebody passed prior to 2020, you have the opportunity, and you're probably doing so already, hopefully, is stretching those distributions out over your lifetime. So that can maintain that account, stretch it over your lifetime, potentially even pass it down to the next generation. So they waived the excise tax for 2024, so it doesn't impact anything this year. You've got the opportunity to, again, wait and not start distributing those assets until next year. Let's touch on year-end deadlines a little bit here. So we have Paladin year-end deadlines. So for any established accounts that are already open here, you need to take RMDs or to execute Roth conversions. You have until December 13th. So we have about a month left before you need to start taking those distributions. We want to make sure they get out on time. So we want a couple of weeks. Now, if you need to open a Roth account, or if you need to set up, move money, or do anything that's not currently established, you're going to want to have that take place as soon as possible. December 13th is the deadline for established accounts, information we already have on hand. Anything new that needs to take place, account openings, move monies, things of that nature, you're going to want to get that done as soon as possible. So if you have any concerns regarding that, just be sure and give your advisor here at Paladin a call, and we'll make sure to walk you through it and get things done in a timely fashion for you. Again, the main thing we want to get across today, regardless of the election, regardless of tax law changes, is focus on those things you can control, right? Look at income and withdrawals, making sure you're doing those as efficiently as possible. Monitor your ongoing expenses. If you have the ability to save more money or still contribute to your investment accounts, be sure and do so. It's going to help you out in the long term. It's more about time invested in the market versus timing the market, right? The other thing you want to do, make sure your investments are allocated properly. Having a plan you can stick to for these items is going to really lessen the impact of the things you can't control. The stock market, volatility, taxes, interest rates, the things you can't control will be impacted by the things you can. So be sure and take advantage of them. Work with your financial advisor and or your tax professional to make sure you execute these things in the most efficient manner for your specific situation. So that is the majority of what I wanted to get across today. On another note, I want to make sure today happens to be the last day to register for our final client appreciation event of the year. If you've been to our office here in the past few months, you know that the first floor, we had a flood occur. The first floor has been completely remodeled. So it'd be great to see everybody come out, check out the new space, spend some time with us before the holidays, pick up your pie of choice. We have 3 options available. We have apple, of course, pumpkin, and pecan pie. So there's a couple ways you can do this. There is a QR code on the screen right now. I'll leave up for a minute. You can go ahead and take a picture of that with your camera. That will bring you to the registration site, or you can go to paladinfinancial.com under community events and scroll down, and you'll see the open house event where you can register to attend the event as well as pick up your pie of choice. So I hope to see each and every one of you at the open house, and we look forward to a prosperous 2025 and spending more time and helping you to reach your financial and retirement goals. Thank you very much for attending. That's going to wrap things up for today. So I appreciate you taking out the time. If you have any questions, any concerns, be sure and give us a call. We'd be happy to help. Thank you and have a great day.